The Federal Reserve is raising interest rates again as it tries to slow down inflation. Thanks for joining us tonight. I'm Jonathan Cooper.
And I'm Tatum Gwynn. Interest rates are now at the highest rate in 15 years. News on 6's Lex Rodriguez spoke to a financial expert about how the change will impact loans. Lex?
The increase means it's going to cost you more per month to pay your mortgage or a car loan. Financial expert Paul Hood says you should really consider whether you can afford a big purchase right now. The Federal Reserve changed interest rates 7 times since February, with an increase from 0.25% to 4.5% where it stands today. This week, the Fed indicated it's going to keep raising rates next year. Financial expert Paul Hood says the fluctuations over the last year are bigger than what he's seen in previous years.
It's usually maybe they go in just 0.1, 0.2, 0.3, they'll adjust it like that. But of late, they've been jumping up 1%, 0.25%, another 0.25%, and so in much bigger increments.
Hood says the changes in interest rates happen as a way to balance out the economy. When products sell fast or supply is limited, the rates go up. For the opposite, the rates go down to encourage buying. Hood says things like increased printing of money and the COVID stimulus payments, which totaled $931 billion, fuels inflation and waters down the value of the dollar, which is what led to the Fed increasing interest rates. But what does that look like for the next year? If rates are steadily increasing, should you go out and buy now? Well, Hood says that depends.
If you can afford it now, that's okay, but don't make financial decisions based on interest rates or whatever, because it's going to be different 6 years from now, 10 years from now.
Hood says to catch up to interest rates, people would need to see an 8 to 9% pay raise. Lex Rodriguez, Oklahoma's Own, News on 6.